What's up, everybody? OSCR Health just released their second quarter earnings. It's no surprise that they're facing a lot of the same pressures that, Elevance, UNH, Centene, all these other health insurance companies that we've looked at are facing. In fact, we basically knew this because they pre-announced a lot of the results of this quarter a couple weeks ago. So we're going to dive into this report. We're going to see what we could expect for the future of OSCR. If you don't know, I'm quite bullish on a lot of these health insurance companies. I think that they're looking really cheap right now. As always, if you get value out of the video, subscribe to the channel. Now, let's talk about OSCR Health. And in fact, before we take a look at the quarter, we have to take a step back, look at what they've done over the past few years, and also just look at the portion of the health insurance market that they're really targeting. This is quite a small company, especially when you compare it to giants like UNH and Elevance, only, $3.5 billion market cap. And they've had incredible growth over the past 5 years. The top line revenue has absolutely exploded from, $500 million-ish 5 years ago to now over $10 billion on the top line. And in fact, for the full fiscal year 2025, this number is going to be even higher, more like 12 billion, but we'll get into that when we look at their earnings for this quarter. Other health insurance players have decent growth, but certainly there's none that I can think of that's as explosive as this. Now, how have they done this? What's going on here? If we just look at the portion of the market that different health insurance companies are targeting, you see that, players like UNH, Elevance, CVS, under Aetna, they're mostly targeting these employer-sponsored plans. And yes, UNH also has a significant Medicare portion. Humana is very much into Medicare. Molina, very much into Medicaid. Well, OSCR Health is targeting the marketplace, the ACA marketplace. That is basically where all of their premiums are coming from. OSCR's not on this chart, but if they were, you would see a huge block of dark green tealish thing, whatever this color is at the bottom of Centene here. And for the past, at least 5 years, the marketplace has really been the place to be. Here's a look at marketplace enrollment over the past decade. You see that it was kind of stagnant and then it just shot up. This has been a massive tailwind for OSCR. OSCR is not playing in Medicare, in Medicaid. This is OSCR's game right here. They are targeting the marketplace. So a natural question you might have if you wanted to invest in OSCR Health is this trend going to continue? What sparked this growth in marketplace enrollment in 2021? And just to give you some more context in case you have never dealt with the ACA marketplace in your life, I have. My wife is actually an OSCR customer, so I'm familiar with this company. But, the prices for an average plan on the marketplace would probably be higher than most people would realize if you are not getting a subsidy. I would just log into healthcare.gov and show you prices, but then I'm going to get spammed with an absolutely massive number of emails and texts somehow. But from Google, it says the average cost of a silver plan, which is kind of the basic level plan on Marketplace, is about $621 a month for a 40-year-old. For a 50-year-old, you're looking at $800 a month or even more. These are quite expensive, certainly more expensive than the average employer-sponsored plan out there. So if you're not getting a subsidy, then probably for most people, I would imagine you don't want to touch the marketplace. So now, if you don't already know, you might have a guess what happened in 2021. It was something called the American Rescue Plan Act. This was a COVID-era legislation, and it massively expanded subsidies to the marketplace. Previously, there were income caps to subsidies. If you made over 400% of the federal poverty level, then you didn't qualify for subsidies, but not anymore. Now they were capped at a percentage of your income. So I think premiums were capped at 8.5% of income. Also, anyone who is getting unemployment income automatically qualified for maximum subsidies regardless of what their actual income was. So the result of all this is that subsidies were offered to many, many more people, and even people who qualified for subsidies before, now the subsidies could be much larger. So guess what happened? Enrollment in Marketplace went up massively. And just to give you another look at this, if we just see on exchange versus off exchange Marketplace, if you're buying off exchange, you're buying directly from an insurance company. You're not buying it on healthcare.gov. You are not getting a subsidy. So these green, they're not getting subsidies. And what do you see? the number of people who aren't getting subsidies going down, 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 down. Either these people who aren't getting subsidies, they're either converting into people who are getting subsidies, they're converting into the blue, or they're just deciding, you know what, healthcare on Marketplace is way too expensive. I'm just not going to get insurance. Really, the entire growth in Marketplace has been on exchange from people getting subsidies, people buying their health insurance on exchange. About 90%, I think over 90%, are getting a subsidy of some sort from the government. Now, these expansions in federal subsidies, they're set to expire at the end of this year, at the end of 2025. So a natural question is, what's going to happen to Marketplace enrollment going forward? I certainly have no special ability to predict politics or predict policy, but I think it's very likely that the current government lets these subsidies expire. And if that happens, I have really a big question mark about where enrollment in Marketplace is going to be over the next, 5 to 10 years. Even Oscar, in their own presentations, this is their last Investor Day presentation. It's about a year old now, but here they're estimating where they think the individual market size will be a few years from now, 2027, without subsidies. Keep in mind today, in 2025, there's a little more than 24 million people enrolled in the Marketplace. Well, they're estimating in 2027, it's not going to grow. In fact, it might shrink. The lighter blue here, this is traditional ACA Marketplace. This darker blue, this is ICHRA. ICHRA stands for Individual Coverage Health Reimbursement Arrangements. And sorry to beat you over the head with a bunch of, specific US healthcare stuff, but I think you do have to understand these things if you want to invest in a company like Oscar that is completely exposed to one segment of health insurance, which is the Marketplace. Anyway, ICHRA is something that the government thought up in 2020. Basically, it allows employers to reimburse their employees for individual market coverage. So typically, if you're with an employer and that employer offers health insurance, they have some employer-sponsored plan, some group plan. So you might be with Elevance or whatever. You wouldn't be buying your health insurance on the individual Marketplace if you are with an employer-sponsored plan. What an ICHRA is it allows an employer, typically like a smaller employer, a company that maybe is 50 to 500 people, let's say. Maybe the employees are a little more spread out. Some are working remotely. They're in different states. It's annoying for the employer to have to deal with a health insurance plan for all these employees. So what they do instead is they say, okay, employees, you're going to deal with your own health insurance. You're going to buy it on the individual Marketplace, and we're going to give you a reimbursement. We're basically giving you a subsidy, but it's from the company instead of from the government. So this has been another tailwind to the increase in Marketplace, not nearly as important as the increase in subsidies that happened in 2021, but still Oscar thinks that there's going to be a growth in people who have these ICHRAs over the next, 5 years or so. Now, going back to this growth that we've seen in people enrolled in the Marketplace, this chart, even though it looks like a hugely dramatic increase, it's actually kind of underselling the amount of increase we've seen in certain areas in the US. If we look state by state, you see some states, there's just been an absolutely massive increase. These dark blue ones are greater than a 200% increase in Marketplace signups from 2020 to 2025. That means they've more than tripled. And there's definitely something in common to a lot of these states that have seen the greatest growth. They are in general the states that have not expanded Medicaid. Medicaid, as you probably know, covers low-income individuals, people with disabilities, children. Well, in states that have expanded Medicaid, Medicaid also covers adults, whether they have children or not, up to, I think 140% of the federal poverty level. It's quite a significant difference in coverage, but in the states that have not expanded Medicaid, you see that, it looked like, Marketplace enrollment doubled. No, in the states that haven't expanded Medicaid, it's sometimes more than tripled. That's the effect that these subsidies have had on the Marketplace. And, when we look at the states that Oscar is targeting, no surprise, there are a lot of the states that have seen massive growth in Marketplace. Oscar knows what they're doing. They're targeting the dark blue states here for the most part. And they've had this massive wind behind their sails in the form of federal subsidies. So again, what is going to be the potential hit to Oscar's enrollment if these subsidies are not extended, which I think they probably won't be? Well, on the earnings call, one of the analysts asked the CEO about this. He said, I know things have changed, but when you're forecasting the market without enhanced subsidies, your number was about 21 million people. Keep in mind, right now we're looking at over 24 million people. I mean, we've seen some other numbers say that the marketplace might shrink by 40% or so. Kind of where do you stand in that debate as we sit now? And Mark Bertolini, Oscar's CEO, said, as we look today, John, we believe that our 18% that we projected in our long-term guidance is the bottom and that it will probably be higher. It almost sounded like Mark was saying growth would be 18%. So the analyst asked, hey, what do you mean by 18%? I'm sorry, just to clarify that. And he said an 18% reduction in the book as a result of what's going to happen. So even though he thinks that they're going to outperform, he's saying they're projecting an 18% reduction in their book as a result of subsidies not being extended. That's pretty significant, and I think it's something that a lot of people aren't talking about when they look at Oscar. They look at Oscar and they just see, growth has been amazing, and the company is guiding for growth to continue. But there is this big question mark hanging over the sector, in my opinion. And it's not Oscar's fault. It's not like they're doing anything wrong. But if we want to invest in the company, it's something that we have to think about. Now, with a bit of that backdrop in mind, let's jump into some of the specific numbers from this quarter. The big number that's going to jump out is this medical loss ratio of 91%. This is what we've seen from basically every health insurance company that's reported this year. Medical expenses are up a ton. Pretty much every company underpriced their plans. And in an industry of razor-thin margins, of course, when you have costs increase like this, the earnings just go up in smoke. Oscar went from just breaking into profitability last year and expecting more profitability this year, but nope, it's a loss. A loss of $230 million for the quarter. Now, it's not all bad news. The top line was actually excellent for Oscar. They're up to over 2 million members, and they're on track for about $12 billion in revenue for the year. So similar to UNH and Elevance, top line is not the problem. And for Oscar in particular, we've just seen every single year, as soon as open enrollment period comes around, Oscar takes more and more market share. They have been expanding into new geographies. And you can probably tell this actually from the graph, but in case you didn't know, the way the marketplace basically works is there's an open enrollment period. Oscar tries to hold on to those members. In general, you can't enroll in a health insurance plan on the marketplace in the middle of the year unless you qualify for a special enrollment period, like, if something happened, you got kicked off of Medicaid due to eligibility or something like that. So you kind of have this stepwise pattern in Oscar's revenue where it's kind of stagnant-ish for 4 quarters and then, here's an open enrollment period and it just jumps up. Going back to the numbers, they highlight as a major issue for costs here an increase in average market morbidity. This is something we've seen highlighted by Elevance and then again in particular by Centene. There's been a kind of market morbidity shift. The population that is being insured by Marketplace is becoming a sicker portion of the population. So back here a few years ago, this group of people that were on Marketplace were a bit healthier. And when companies like Oscar are setting their rates, when they're setting the prices for their plans, they're looking back at past history and they're using that to guess, what are our costs going to be for this population in this year? Well, pretty much all these companies did not fully account for this shift in morbidity. That's led to an increase in their net risk adjustment accrual. Basically, the way these risk adjustment transfers work is if you are insuring a way sicker portion of the population, if your members are way sicker than the average person on Marketplace, then to balance it out, you will get a risk adjustment transfer coming back to you, coming back to your company. So what's happened with a lot of companies that are really involved in the marketplace, and we heard Centene talk about this on their call. They said, we thought that we were insuring a much sicker portion of the population, so we thought that we were going to get a risk adjustment transfer coming to us. But actually what happened was the overall market got sicker. So it's not that we were insuring a sicker portion of the population, it's the population as a whole got sicker. So we're not actually getting any risk adjustment transfer at all. In fact, in some cases, you might have to owe a risk adjustment transfer if your portion of the population, if your members are healthier than the average person in the marketplace. So Oscar is taking a pretty significant loss here for this quarter. Now, in spite of the headwinds, there definitely was positive stuff on this call as well. They said, we're also launching a new ICHRA product that's basically geared towards connecting companies that want to go the ICHRA route instead of an employer-sponsored plan route, to link those companies with Oscar. And they talked about one of their first partners here, which is going to be Hy-Vee, a kind of mid-size grocery store chain in the Midwest. So that's exciting. And management said, we believe the market will stabilize next year, and we expect to return to profitability in 2026. To do that, they certainly have to increase the prices of their plans. And in fact, actually, one of the funniest moments on this call came when one of the analysts asked, here it is, this analyst asked, yeah, so what are you thinking about rate increases? I mean, you have to increase rates. What are you going to increase rates to? And the CFO said, yada, 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 market morbidity, subsidies, enhanced subsidies. So that gets us into double-digit increases and sometimes significant double-digit increases in some of our biggest markets. And the analyst said, yeah, and then just to clarify, when you say double digits, is that just between 10% and 99%? Or, can you narrow that down for us a bit? And the CFO's response was, I would say that you are correct in terms of that number could be any of those. I don't know why I just found that response funny on the call. But in all seriousness, an increase in rates of 10% is very significant and probably what's needed here to get premiums more in line with costs. Management on this call also reiterated their long-term profitability guidelines of growing the top line at 20% through 2027 and achieving 5% operating margins by 2027, which would be fantastic. They've also given a $2.25 earnings per share target for 2027, which if they hit that target, Oscar is definitely a buy today. I mean, at today's price, Oscar is trading for, like 6.5 times that 2027 target earnings per share. So if you're confident they're going to hit that number, they're a buy every day of the week. And as far as the market's reaction to this while we're looking at the chart, it seemed to be mostly positive. I mean, the stock dipped really briefly and then it bounced back. It's definitely up quite significantly now from before the report, but also keep in mind, they sort of pre-announced the results back here. And when they pre-announced the results and the market realized that, this wasn't going to be a good quarter, the stock dropped. So a lot of the negatives were already priced into the stock. Now, getting back to our sheet, let's see what we could expect for a return on our investment if we buy Oscar stock today. Price is now a little higher from the last time I updated this, so I'm just going to re-update my sheet again. All right, so here we go. Now, when a quarter is just released, my sheet always takes a few days to recognize it, so I apologize. My trailing 12-month data here is 1 quarter behind, but it's not going to make a huge impact on our forecasts. I mean, really what we have to decide at the end of the day is what is the future of Marketplace going to be? I think Oscar has clearly been executing extremely well. And as customers of Oscar, we've been reasonably happy with the service. I have no reason to dislike Oscar Health. So if you believe that management is going to hit their long-term targets, then I think Oscar is a buy. I mean, if you just put in 20% revenue growth on the top line, which they've actually been outperforming recently. And if you think that they can hit their 5% operating margins that they're guiding for, then, giving the company a 15 times multiple, which I think is not unreasonable, you're looking at an absolutely outstanding 40-ish% annualized return on this stock. This is a 5x for Oscar stock over 5 years. This right here is the upside potential that we're looking at. Now, my big question when it comes to Oscar is, what is going to happen if subsidies go away? Again, just to reiterate, it's because of subsidies that we've seen triples in the marketplace enrollment in a lot of the states that Oscar is targeting. I think it's very likely that these subsidies will expire at the end of 2025. And then, I want to see what happens to marketplace enrollment going forward. Right now, I don't own a position in Oscar. I own UNH, I own Elevance, I own Centene. I own a lot of these health insurance companies, and I think they're undervalued. I think it's very possible that Oscar is undervalued today. But I just want more clarity on where marketplace enrollment is going to go without subsidies. It's hard for me to even guess, what the spectrum of possibilities is. I can't say for certain how likely this bear case is. I can't say for certain if it's possible that you would see a greater contraction in revenue if subsidies go away for companies like Oscar that are fully exposed to this. And honestly, one of the great things about investing is, you don't have to swing at most pitches. You don't have to swing at hardly any pitches in investing. I think Elevance looks like a no-brainer. It is my largest position in this sector. I think Oscar might be a huge winner, but as far as what I'm doing with my money, I'm just going to wait until 2026. I'm going to wait till I get a little more clarity on what's going on with subsidies and how that affects Oscar Health. Does that mean I might miss this amazing return in this bull case? Yes, it does, and I'm okay with that. I might change my mind. I mean, I could easily see myself owning Oscar at some point in the near future, but for right now, I just want to wait and see. It's definitely a company I'm going to keep following. I'm going to keep it on my watch list. I'm going to be looking for any pullback in price, and even more importantly, I'm going to be looking at what's happening with subsidies at the end of the year. If you got value out of the video, subscribe to the channel. If you agree or disagree with anything I said here, leave that down in a comment below, and also let me know if you own Oscar or if you're thinking about buying Oscar, what are you doing today? And as always, I hope to see you all in another video.